Ladies and gentlemen of the crypto space, we're live on a Wednesday, August 30th at 11:34 a.m. The lonely path of someone that sees something that other people don't see. The vast majority, you know, it is what it is. We're not here to talk down upon the majority. The majority are what makes society what it is. But after research, investigation, due diligence, and realization, people are able to see things that other people don't see. And it's not necessarily the case that there's no history, no precedence for systems or enterprise that we see opportunity in, growth into the future with regard to adoption, consumption, with regard to utility, and and the history is there. And all that was needed is the story to put the puzzle pieces together, and that's something that the reason why this stream exists. It's my particular journey. And it seems to be the case that the journey has great history. People see that after I tell the story, and they're like, oh, that kind of makes sense. Now, I'm going to stick to this journey, this path, no matter how lonely it gets as this community, and obviously this particular community, our rational community, dwindles to the few that have been able to avoid degeneracy and maintain capital in a way that's sustainable, but even more so for the entirety of the space. The vast majority don't see this path. They don't see this journey. They don't see these systems and the long history of complexity in traditional finance. It's a little bit of a chicken and the egg, the way I found these stories we talk about. I mostly found traditional finance, or these characteristics, nuances of traditional finance vis-a-vis crypto markets, not necessarily the other way around, which is what it is. Probably many traditional financial persons would find that interesting. But in any case, it wasn't my history in traditional finance that led me to crypto markets. It was me looking for context, relevance, comparison, analogy, simile, some might say. And it's been there. And the story isn't going to change. It's not like the story's invalidated. And the beauty of it is we get to see how the story plays out. So I very much look forward to that. We're looking at Bitcoin here, ladies and gentlemen, which had a nice victory yesterday from a court perspective. Pushed back above the 200 SMA, coal denominated. This is coal. And then broke down this week, even considering the court victory. So perspective is important because obviously the journey we're on with regard to understanding macro financials and the way the fiat currency systems work around the world require us to look at things from a different perspective. This is such a different perspective. We were higher, so coal has been outperforming. Now, coal is obviously 20% of electrical production, and that is the fuel, that is the input cost into Bitcoin production. So this makes Bitcoin a little bit more expensive to produce. Natural gas will offer that perspective as well. Above the 200 weekly, below the TWAP, time weighted average price. Now I put this little time and value indicator a little bit earlier. I posted on Twitter that would be an interesting inverse head and shoulders, pretty pronounced inverse head and shoulders. So what does that mean? That means Bitcoin could depreciate 17.74% against natural gas over the next 140 days and still have a wonderful looking chart pattern with regard to reversal to the upside. In fact, Bitcoin is not that, is a very different story to be told with regard to Bitcoin as compared to as compared to fiat currency with regard to its current price point. So it's down 58%, and Bitcoin US dollar denominated is down about 60%. So it's about the same, but you could tell the structural difference, which I find quite interesting. The peak of Bitcoin natural gas denominated was in April of 21. The peak dollar denominated was in November. So it's a very different time period. I guess it more closely aligned with the first peak. So this double top was a monetary phenomena. It's pretty interesting, actually, in that regard. It basically invalidates the second peak as being significant, um, highlighting that it was just relative to money rather than an actual input into the production requirement of Bitcoin itself. Notice there's no second peak. And we'll draw that real quick, which is quite interesting. This was much more pronounced from a monetary perspective. That's quite interesting. So these charts I like to look at, energy input costs considered, there could be significant downside. And the structure is still quite interesting. Unlike dollar denominator, look at the weekly. You're significantly above the 200-week moving average. And then on Bitcoin, you are actually below the 200-week moving average. So there's actual quite the reason to not expect dollar-based appreciation. Excuse me. So yesterday, the court ruling, everyone saw the $1,000 move to the upside, but as of right now, it's been rejected by both the TWAP on the weekly as well as the 200 weekly moving average. It's not something folks talk about. So now I understand folks talk about like Bitcoin outperformance versus all altcoins, but is that an investment thesis? Is that reallocate everything you have to Bitcoin? Is that the type of investor folks want to be? I mean, obviously that's the case with like Bitcoin maximalism, and that's obviously a religion where nothing else can coexist, and nothing else is significant, and everything else is inferior. And I find that narrative quite distasteful. I would own things, and in fact I do, but I do them intentionally, understanding that there's a good chance Bitcoin outperforms other assets, but that doesn't mean much to me. I'm not going to pile every piece of cash I have into Bitcoin denomination. No, I want to own other things. And it would be awkward not to own Ethereum, to own gold, to own euros. And what's pertinent is to rebalance that cash position accordingly as you expect outperformance versus one or the other. Anywho. Hope that helps a little bit. Maybe that was a bit of a digression. Ethereum, on the other hand, from a technical perspective on the weekly, is above the 200-week moving average and below the TWAP. So there is downward pressure on both of these assets. But from a technical perspective, Ethereum does look structurally better. And it's still relatively below its Bitcoin denominated price point in the most epic triangular compression many people can reference. That is absolutely massive, obviously logarithmic, and I don't know what kind of comparison we could have to traditional financial assets, but this is a absolutely massive triangular compression. The measured move is just, it's through the roof. Look at this. Look at the aperture. This is a massive measure move. If that breaks, it's like heading into 2030 type decoupling. But we don't see that kind of decoupling. We see relative consistency all the way back until May of 2021. And that's after the significant outperformance of Ethereum denominated in Bitcoin. Few talk about that the fact that the last low compared to where we are, Bitcoin is up, Ethereum is up 276% in terms of Bitcoin. Ethereum has outperformed Bitcoin by 276% since December of 2019. Okay, so if Bitcoin has been outperforming a little bit since the top, for instance, nope, not date range, price range. If Bitcoin's been outperforming since the top and is down 25%, this is exactly what cash rebalancing is for. This is literally a Forex spread. This is the spread between euros and dollars or yen and pounds. So when Ethereum is done outperforming, you buy some Bitcoin. When Ethereum is done outperforming, the odds are Bitcoin's coming down also, so it's not necessarily the best to reallocate entirely to Bitcoin. You reallocate some to dollars, or maybe the dollar, if you go over to DXY, is being outperformed by euros. And in fact, that is the case. To such a degree, look at this outperformance of dollars, of euros compared to dollars, 12%. So the appropriate thing since September of 2022 wasn't to sell crypto, to sell Ethereum or Bitcoin for dollars. It was to sell it for euros. Go figure. So we're very much clearly discussing the composition of the cash position of the portfolio, as I will continue to tell my story for how I view these assets. You have to recompose, you have to restructure, rebalance. And we look at these charts and we have the data we need to see whether you buy euros or dollars, for instance, whether you buy Bitcoin. But it clearly is the case that fiat currencies have outperformed Bitcoin and Ethereum over the last year. Since Q4 2022, you could have bought any fiat currency and have had it appreciate significantly more than Bitcoin or Ethereum. Now, when I say appreciate, the absence of depreciation is there, meaning that's outperformance. You outperform to the downside as well as the upside. Now, bear in mind, if you bought euros rather than dollars at the top of Bitcoin and Ethereum Q4 2022, you would have outperformed dollar denominated. And if you buy dollars right now, you'd have 12% more dollars than if you bought dollars in Q4 of 2022 using your significantly appreciated Bitcoin or Ethereum. I find this chart fascinating. You know, Bitcoin denomination. It's such a trend or such a common presentation that Bitcoin. Bitcoin's cool. It's just a currency. It's cash, and it has periods of outperformance and periods of underperformance. And you have to consider Bitcoin in the context of Ethereum, because it's a macro asset where Ethereum has outperformed hundreds of percent. And you have to consider it in the context of available fiat currency. So if you're into Bitcoin and Ethereum, you have to be thinking in terms of euros and pounds, which are probably most accessible in the West, and in the East, yen and yuan, if you could get your hands on it. So that is something to consider. You know, I'm not fond of just, having just pure Bitcoin or pure Ethereum. You have to think about rebalancing these forex currencies. Everyone started Bitcoin talking about peer-to-peer money. What the hell happened? Now you just gotta hold it through the depreciation? I literally nowadays lump Bitcoin in terms of a currency, which is literally where Bitcoin started. So maybe my story is more or better aligned with what Bitcoin is than the current Bitcoin story. Opt out of the system, inflation protection. Yeah, you outperformed significantly if you rebalanced your cash position into dollars, and then you outperformed another 12% if you rebalanced your cash position into euros since September of 2022. So then you rebalance from euros to dollars, then you rebalance from dollars to Bitcoin as Bitcoin shows the directionality shift towards appreciation. But that's the start of an entire other conversation about the macro financial setup. And that's why You never go all in, specifically with regard to your cash position. And you always diversify to a degree and rebalance considering potential risks on the table. There's significant risks on the table, and we look to the bond market in that regard. Now we'll see what plays out, but the volatility has been suppressed for the time being, and for that we go over to the move indicator down back at 110. Every time there's a spike, it gets smushed below the 50 on the weekly, which is good to see. I would love to see a clear directionality play out. This is like an 18-month rolling top at this point. Either we're going to have another volatility spike, or we're going to start to see finally the bond market come down and allow offshore printing to resume, expansion of liquidity. We start to see some sort of stabilization in Japan with regard to their market, maybe capital inflows back into Japan and not necessarily a full unwinding of the carry trade. That'd be nice because that would clearly disrupt U.S. domestic interests from a fiscal standpoint, and that'll warrant intervention from the Fed to be the buyer of last resort to suppress bond volatility. If you saw that occur, you would see it right on this chart. Bond market volatility would spike through the roof if all of a sudden Japan became too much of a strong investment interest and the carry trade started unwinding. Let's look at the dollar real quick. So this is quite interesting, and this brings me great comfort. As of right now, let's go over to the monthly. Now it's the weekly chart I was looking at. Look at this price on the dollar. I am hoping to see the dollar close below 103.427. So there is 2 days, 8 hours left on this DXY chart. And if it closes here, holy crap, that's a bearish engulfing. So we have 2 periods of time to consider. 1 and 2. Look at the follow-up candle from the green bullish candle. Hanging man, and this is like a spinning top or something. So this signifies basically indecisiveness. This is a hanging man, and that has bearish overtones. That's a shooting star coming after a hanging man. So that's kind of like confluence of continuation to the downside, and boom, there it goes. Indecisiveness. So this is maybe why this was so weak compared to this move down. But a bearish engulfing, I would say, is more comfortably bearish as compared to a hanging man, which didn't get all the way to the open of the most previous candle. So obviously, from a weekly standpoint, the close this week and next week are very interesting. Candles matter. They tell you directionality. I would love to see a close below the 103.427 and continuation to the downside. I would love to see a breach of the 100 on the weekly and then a retest. Notice the retest here went right through, smashed through the TWAP as well. So what you want to see is when it comes down and pushes through the 100, you want to see here, and here's the 100, you want to see an expression of resistance. Expressions. If you start to see the wick, look, there was a wick here in the third week of July. It wicked through, but then it pushed through. So you need that second candle of confluence. And so if there was another wick through and then it rejected and started moving towards the downside, that would instill a bit of comfort. And after 2 or 3, maybe 4 weeks, you can get a sense that that moving average is flipping into resistance. So what you see is an expression, and more often than not, wicks are a good indicator of expression of resistance and support. And if you get a full candle body close with very little wick to the downside, that is comforting. As confluence, that is an additional piece of information compared to a wick, like say it wicks back up to 103.320. Maybe it's not necessarily the case. But a close below, generally, the 103.427 would be indicative of reversal and rejection by the weekly 50. What's interesting is it didn't touch the weekly 50. What's interesting is maybe this is a little too easy top. It's a little bit more pronounced of a top with a single candle. This has two wicks that are getting there, almost similar in structure. And in fact, it closed at the exact same height as it. That's interesting. Oh, but that's a nice shooting star right there. Albeit it did have to project a little bit higher than the most previous open and then further previous close. Let's zoom out a little bit, and then I'll answer some questions and we'll see what's going on. Look at that 6 month. That is one heck of a shooting star on the 6 month. I don't care what anyone says. That is a very, very big wick. That is a bigger wick than 1985. And if they want the system to continue, as Brent Johnson talks about, the dollar has to come down. And the dollar doesn't come down organically. It comes down because of geopolitical collusion. It comes down because the powers that be and the regulators regulate it down. They collude it down. Who's in the house? Dan's in the house. Kazika, Pleasure, Tapsy, Juan, Roman. I know the path of pain and glory. Well, the path of knowing you're right. I mean, I guess that has overtones of faith to it. But at least there's data supporting faith. We have precedents, history. We have data over the last 3 years indicating flow, indicating value capture, not even just value, because you could also talk about liability capture, which has all the overtones of an emerging market. Is that how you would look to a new country, or you would look to Brazil? If you look to Brazil, for instance, an emerging market, relatively strong emerging market with a lot of natural resources, how many dollars did they have last year versus, let's say, December 31st of this year? How many dollars do they have this year? If the amount of dollars they have this year compared to last year is 20% higher, they're doing something interesting. People are buying things from them and they are capturing dollars. So that's a valid way to look at a market, an emerging market, because why would they capture dollars? They have something that other people are interested in. So that's a way you can look at crypto markets. If there's more liabilities in this market as compared to last year, then something was done, something was offered, a product or a service that captured those dollars and made them sticky. They didn't want to leave. There was value to be had for them to remain in the space. Now, we've gone over those numbers. I don't recall them off the top of my head, but if you compare to like December of 2019, January of 2020, the liability capture of crypto markets is thousands and thousands of percent. I believe that off the top of my head, the total liabilities in December of 2019 was 12 million, $12 million, give or take, on Uniswap, something like that. Maybe that was January of 2020. But I have some posts, if you look back far enough, maybe 2-3 weeks ago, that indicated it was in microscopic numbers. But there was billions of dollars of stable coins, but they weren't in the DeFi space. So point being, Uniswap was everything. It's actually nice to look at the history of the DeFi space because Uniswap was the entire DeFi space in Q4 2019 and Q1 2020. There was nothing else. So you can literally like look at the LPs, look at old V1 Uniswap.info, and you could see how small of a market it was. So everything since then has been liability capture. When bullish news doesn't really move price. Well, you could say that again. If you're looking on the weekly, you are clearly being rejected by the 200. In fact, it's pushing below again. So I would take bullish commentary from other social media with as a grain of salt. It doesn't really mean much. I mean, how do you argue anything other than what you're looking at on the screen right now? It was rejected. This is an expression of resistance. So obviously, if you push through, that is an expression of resistance to resistance, which is continuation. You see support, you see a push, a momentum, a shift. And that is not what we're seeing right now. We're seeing an expression of resistance. But look at the most previous one in June of 23, an expression of resistance and then a really quick breakthrough. So this is what everyone talks about. When you break through big. And that was literally $4,000 or $5,000 rip to the upside. So these are the types of numbers you have with Bitcoin, but look at that volatility over the following weeks. These are BARTs, as many folks call them. But this is why you have some exposure, even though it's depreciating. It's okay to own things that are depreciating. What you want to have is appropriate time horizon and appropriate expectations, such that you're not running around frantic and making irrational decisions. Was the same at 16K with bearish news? Well, we'll see. Obviously, we could compare it to history, but in the end, we're looking at today. And we look at weekly closes and monthly closes to find some comfort on directionality. Oh, the pain of being in this market. Yeah, that's exactly why I titled the stream what I did today. But, if it brings anyone comfort, I'm very calm. I don't really have too much emotion about this behavior. Obviously, if everything gets cut in half by 50% and we have some sort of liquidity crisis, I'm going to be looking at the data like, oh, do I have enough capital for next year? Do I have my cash position balanced accordingly? What's going on with weekly cash flow? Are any of the narratives invalidated? Can I liquidate anything? Can I rebalance the investments? And for what it's worth, I don't have many choices and options. Most of them are long-term lock positions, so that brings great comfort. Great comfort. So many folks are afraid of the lock position. For me, it's like click lock. When we took that convex position I mentioned on Discord maybe a couple weeks back, 2 weeks or so ago at this point, yeah, I literally bought it and locked it right away. I didn't even hesitate for a second. Maybe that makes me a sociopath. I hope not. Good to see you and learn from you, Noah. It's always a pleasure. We're doing good. We're doing good. Tapsy reminds me of a quote from Margin Call. It wasn't brains that brought me here. I assure you that. Well said. Well, it's innate understanding, intuition, and he was able to tell a story, being able to define things in different terms so other people align and follow suit and agree and are on board. That's what a leader is. So the first person you have to lead is yourself. So be confident, at least in your own capacity to reach conclusions and make decisions. And if you find yourself indecisive, seek reassurance. Seek confluence for your own ideas. And don't hesitate to invalidate ideas. But find that confidence. It's imperative. With inflation coming down to 2.7 and unemployment at 3.5, Fed has been doing a good job so far. 1 year ago, it was mostly doom and worst case scenario. Why no hard landing? Well, for hard landing, you got to look to Japan and China. And so far, China has been papering over their system. If you look at the amount of money supply increase by China, it makes the United States look like a saint. The largest currency expansion by far is China. Everyone is quick to call out the United States for printing all the money they did in 2020, and it wasn't much compared to China. I just find so many false narratives. It's kind of scapegoating. And obviously, that makes sense for Bitcoin. Point fingers at the U.S. currency and call it names and to prop up your own narrative. And, that makes sense to a degree, but I don't see that kind of value. I don't like that. Bitcoin has a much bigger narrative than that. I find that quite shallow and cheesy. Bitcoin is great, not because the dollar is bad. Bitcoin's great because it's not the dollar, it's not the yuan, it's not the yen. And, the concept of immutable monetary policy, yeah. But it's not great to me because I think the dollar is bad. Obviously, dollar has negative considerations. The subjective monetary policy, I prefer deterministic, immutable monetary policy. U.S. monetary policy is quite mutable. So that's the argument. It's not, ooh, dollar bad, Bitcoin good, protect money, hard money, and protect against the evil debasement of the U.S. dollar. That's not the way currency systems work. And in fact, just I don't really think Bitcoin works at the largest of scales, but that's another story. Anyway, I believe very much in elastic currency, but it's neither here nor there. I don't understand the need to incorporate multiple Forex pairs into my decision to own Ethereum. I have no Bitcoin exposure. What's wrong with the binary option of ETH USD? I agree. Me personally, I don't have, I have, dust Bitcoin exposure, like a half a Bitcoin maybe, in a wallet somewhere. But my cash position predominantly is denominated in Ethereum and dollars. Skewed heavily towards dollars in traditional finance, banking institution. But as few folks that see my online wallet, that's my online cash is mostly Ethereum rather than stable coins. And I don't mind that Bitcoin outperforms for a period of time. It could outperform 20%. I'm not going to sit here and rebalance. I'm not a trader. So if you're rebalancing the cash position, do you think Bitcoin is going to outperform Ethereum over the next 6 months, a year? I don't think that. So, that's like going over to this chart and looking at the 278% appreciation, 276.49% appreciation since January of 2020 for Ethereum. So at some point, Ethereum outperforms Bitcoin once again, even if Bitcoin outperforms Ethereum 20%. I'm not going to sit here and trade. So I appreciate what you're talking about, and I execute pretty much the same way. Seems like it's a simpler equation in my opinion. And yeah, and what are you going to get? 10%? 40 grand, you get a 10% rip and you make 4 grand? No, that's not how I'm going to spend my time. I have a certain amount of capital, dollar denominated with regard to Ethereum or stable coins or cash in a bank account, and I live my life accordingly. And that's fine. And if the Ethereum is worth less, it's worth less. And it's going to be worth more in the coming years. At least that's the prevailing directionality, at least Bitcoin denominated. I don't think we see moves like this again. There's a very different time in 17. One, it's deflationary right now. It's a deflationary currency. And that's it. It's just significantly less supply. Bitcoin's number of units in circulation are going up, whereas Ethereum's number of units in circulation are literally going down. I mean, look, 61 Gwei at the top, 59 Gwei. You literally are burning every day. So I'm not too sure what the argument is, other than obviously security, in which case I completely agree that the odds of Bitcoin changing are monumentally less than consensus being reached with regard to Ethereum to change its implementation. Sure. Okay, what do you think? It changes instantaneously? No. Reallocate if need be. But as of right now, the monetary policy and properties of it as a currency are far superior. And if it becomes not the case, if all of a sudden this is down at 5 and there's no activity in the network from a gas perspective, and it's not burning and it's inflating, and or maybe they mutate the monetary policy, and it's just I don't understand the rationale. If a narrative's invalidated, you can adjust. But as of right now, the properties of Ethereum are far superior to that of Bitcoin. It is what it is. Sir Joe, present. Hello. Brian, good morning. H-Diz, dollar looking weak, but sitting on the 200. Well, it depends on which dollar, if you're looking at it versus the euro. Look at the yen. Yen is still quite elevated. We don't have a firm retrace with regard to the primary currencies. That's really Japan, euro, and yuan. Yuan just blew out. They really devalued significantly to prop up with their looseness in their monetary policy and stimulus efforts, much more than even Japan, considering their bond market. Look how much further you got to a double top. Japan only got to here, then the yuan pretty much almost got to a double top. Maybe it blows out to the upside. So there's plenty of risk still in the currency markets. The risk in the currency markets it's chicken and the egg, where the risk comes from in the currency markets versus the bond market. It's kind of like they both influence one another. But in any case, you'll see it. You see any significant delta in any of these four charts, DXY, USD GPY, USD versus Euro, and USD versus Yuan, or the move indicator, which is a decent way to look at the volatility of, on average, the US bond market. The volatility is what causes significant price changes, especially in risk assets. Um, Potential for a third drive of the weekly bearish divergence here for DXY, target 89. Let's take a look at the DXY. You know, 89 would be wild. And obviously, you're putting at 89. I'm not going to go that far right now. I mean, I'm looking for, let's go out to 6 month. I mean, if you get to the end of the year to something like 97, that'd be freaking crazy. That's the TWAP on the 6 month. And on the monthly, if you get to 98, you're talking about the 50 on the monthly. Odds are there's going to be an expression of support. And then, the TWAP comes down and maybe you bounce to like 100, 102 as compared to where it was up here, 105. And we'll have to see what kind of structure emerges with regard to currency flows. But generally speaking, if you see this chart come down, you know what we're talking about. Then it's not going to be a lonely path anymore. This chart comes down significantly. That's when they come. Who? The degenerates. And then we get to have some fun. I'm split between Ethereum, SFRX ETH, and WST ETH. Thoughts on risk with that split? Adjust accordingly. Position size accordingly. There's a greater risk exposure with SFRX ETH, WST ETH, compared to ETH. So if you have that, if you're risk on, why have ETH at all? If you're concerned and considerate of risk, maybe skew it 2/3 go to a base ETH position and 1/3 go to the other two. So this is the art of portfolio composition and portfolio balance. Personally, myself, I have a need for a certain amount of capital next year. I have plans, and so I have just ETH exposure because I need this capital. So I don't want to entertain any counterparty risk. That's not to discount that those are remarkable protocols. And obviously we have our sentiment with regard to the Frax protocol. It's well known, and we talk about that often. So that's food for thought. I hope that helps. Now, it's not cookie cutter. It's not, do this, do that. It's complex choices that we make. And we're dealing with, that emotion and anxiety. And in the end, do whatever you have to do to sleep well at night. That's the bottom line. Because if you could sleep well at night, time does the rest of the work. Time is what you want to do the work, not your choices. What you want to do is align with directionality. Then time does the rest. Captain, do you not like to LP volatiles? From your previous answer, what about stable USD pairs? So you could LP under two conditions, in my opinion. What I've done, I've had, a NOLO ETH LP for like about 2 months and a half, literally since it came over from Solana. It was a micro position on Solana. It came over, and I put up some ETH so could balance the LP, and the LP's just been doing what it's doing. I have no real need to think about it. It's kind of like house money. So the bottom line there is do what you have to do to sleep well at night. So I don't feel comfortable taking a significant amount of capital that I need or want, or don't want to, take risk with, and I don't want to deploy that. So it also depends on how you manage the portfolio. Maybe you do want to take that kind of risk and you could sleep at night. So I've been able to comfortably have that position, and it just does what it does. It's quite productive. That's a complexity. What Hero and Noah are doing, their LPs are getting a fair amount of fees. There's some nice revenue for Hero ETH, the LPs, as well as obviously no ETH LPs on mainnet. So that's something to consider. I generally don't like that kind of risk exposure from a liquid perspective. It's very hard for me not to liquidate if it is liquidatable. There comes a time when anything that's not nailed down gets sold, and that maybe the hardest one to digest that reality with is your own capacity to not liquidate something that can be liquidated. Food for thought. Captain, I nailed that one. Okay, ladies and gentlemen, thank you for joining. 18 people on the stream, 8 likes. Hit that thumbs up button. I appreciate all of you. Reverse repo still coming down. Treasury General is at 413. Obviously, the difference funneled into bond market. We'll see what happens. RSP is an interesting chart. Equal weight S&P 500. Looks like a breakout above the TWAP and a retest. There's no reason it can't go higher unless there's a significant interruption in liquidity. And in that regard, that's where Mike Howell's interpretation of market pressures is quite meaningful. Could be boring. It could be quite boring in markets for some time until there's a catalyst. Just like yesterday's event was a short-term catalyst. But bear in mind, even in the most bearish of conditions, I talk about often that there's a tremendous amount of liquidity out there. What happens if equity markets sold off? Where's the capital go? Does it go to bond markets? Oh, interesting. If the bond markets rip to the upside, what do you do with bonds? Oh, you print dollars offshore with them. That's the purpose of U.S. collateral in the prevailing market is to print dollar liabilities in the traditional Eurodollar market. So bond rallying is a precursor to significantly increasing liquidity conditions. Just then the question becomes, where does the liquidity go? And in my mind, liquidity is risk arbitrage. So where's the least risk? So from my perspective as an investor, I think the crypto markets have significantly less risk as compared to equity markets. Yeah, there's the regulatory risk consideration, but this is a market that's outside the scope of any particular nation. This is a market of all nations. So I think the crypto markets are overwhelmingly a destination for capital heading into 2030s. Curve. Let's look at curve. 46 cents. So the only thing you can take away from this chart right about now, there's no real structure left to that inverse head and shoulders that we were looking at. But this is that horizontal price action that we've noted on stuff like Aura mostly. It's not down. Not down. And not down is interesting, considering the way the currency is created, the currency is distributed, the currency is recycled, currency is sterilized, and all these semantic terminologies we talk about. So that's quite interesting. Not down is interesting. So that's clearly not the prevailing narrative for why folks engage with these markets. They're like, oh, is it up 10x? Is it up 50x? Is it up 100x? Not down is quite freaking interesting. The problem is, all the fun that was had in 2020 and 21 was that degenerate yield and 3x3 insanity. What you want is a rate of return that's significantly above the risk-free rate of return. You need to be compensated for taking risk above and beyond risk-free. So 10, 15, 20, 30% is freaking crazy compared to bonds. And this is obviously very productive, 30+%. Right up my alley. Oh, thank you all for joining. I appreciate your time. We're at a Wednesday. We'll be back on Friday. Tell everyone to subscribe. In the description is the link to our Discord, the most rational community in the entire crypto space. I appreciate everyone surviving in there together. I will see you again at the end of the week. Peace.